Hard to believe there's a science behind money market funds, but we're going to talk about it in episode 29. Welcome to the Mullooly Asset Show. I'm your host, Tom Mullooly, and this is episode number 29. Mickey Lolich. Was this guy a great pitcher for the Tigers or what? Mets, typical Met trade, so Mets. They trade their best hitter, Rusty Staub, for a washed-up Mickey Lolich by the time he came to the Mets, and he was terrible. In fact, he knew he was terrible. He quit. The season, at the end of the season, he retired. He opened a donut shop in Lake Orion, Michigan. He actually came out of retirement a year later, and he pitched 2 more seasons for the Padres. But thanks, Mets. You traded away Rusty Staub, and you got Mickey Lolich. Good deal. Anyway, episode number 29 is going to be a lot better than what the Mets got for Rusty Staub. So we're going to talk about the science of money market funds. And what we do when we do these videos is we get questions from our clients, we get questions from people who watch the videos, and it may not even be a question, it'll be, hey, I had a question about something else, and that kind of spurred the conversation. So we got a very interesting question about money markets this week. Casey's going to read it to us, and I'm going to kind of take the lampshade off the guy with the party when it comes to answering the science behind money markets. Casey, what do we got?
I've been getting a lot of mail about money market funds recently. Is any of this important?
Surprisingly, money market funds can be complicated. Well, they can be complicated if you want them to be. It's kind of like learning how a watch works. A lot of people don't care how the watch works. They just want to know what time it is. Money market funds kind of work the same way, where a lot of people, they don't really care how it works. They just want to know that when they need the money's there. There was a big risk. Going back to 2008, there was a question about whether the money was even going to be there or not. So there is a little bit of science behind money markets that a lot of people don't even take the time to look into. So let me start out with a question. Have you ever looked at your brokerage account statement and you'll see the money market line and it'll say something like 25,236, and you think it's dollars, like, oh, so I have $25,236 in the money market. Technically, you don't. You have 25,236 shares at $1 each. That's true. You don't have dollars. You actually have shares of a money market fund. But the shares of a money market fund trade for $1, and they have daily liquidity, and there's no cost to get in or get out. Why the shares? Well, technically, in the business, we all call it a money market fund, but the technical name is a money market mutual fund. That's right. It's a mutual fund. And so when you put money into a money market fund, that money gets invested in some super, super short-term stuff. Investments that come due usually 30 days, 45 days, 90 days would be the max. So the first thing is understand that you're investing in a mutual fund. So you have shares of a mutual fund. The second thing is, if you remember back 10 or 12 years ago, or even further back, the yields on money market funds used to be a lot higher. I mean, it wasn't a surprise back 15 years ago to see 3.5% or 4% on a money market fund. Can you imagine a money market fund that would pay 4% today, Casey? I mean, that would be outrageous. And that's more than a 30-year treasury would pay right now for daily liquidity at no cost. I mean, that sounds fantastic. But those things aren't available now. Why is that? Why are rates at money market funds down near zero? It doesn't really make a lot of sense. Well, to examine that, you have to realize what was in money market funds years ago. The rules were a little looser on money market funds back then. You didn't really have such tight restrictions on what could go inside of a money market mutual fund. 2008 changed all of that. If you go back to 2008, in the fall, Lehman Brothers was in a lot of trouble. Lehman Brothers and a lot of other investment firms, all of them were circling the drain. They were all going out of business. But Lehman Brothers was the one that finally went bust. And the problem is Lehman, like a lot of other banks and investment firms, were issuing a lot of short-term paper, stuff that would wind up inside of a money market fund. And so when Lehman Brothers, all these firms went down, and so they had to kind of, carry these things at face value. But when Lehman Brothers finally went down the drain, all these money market funds that owned that paper had to pretty much write off or write down the value of their investments. There was no way around it. And so what happened was, the big rule with money market funds was whatever is in the money market fund, whatever investments you have in it, at the end of the day, whether prices went up or down, sideways, whatever, at the end of the day, everything had to add up to $1 per share. That's why you have $1 per share on your statement. Well, when that week that Lehman Brothers went out, there was no more adding up to $1 a share. A lot of money markets just couldn't reach $1. And so when they can't reach this $1, there's an industry term called breaking the buck. If you wound up less than $1 per share, you were breaking the buck. And we started to see money market funds run a real risk that they were going to break the buck. Can you imagine? If you had 25,000 shares at $1 per share, you could have lost money in a money market. Does that sound silly? It's hard to believe. And if that's a risky investment, then what about stocks and the stock market? It was just a negative downward spiral. So what happened? Well, the government stepped in the fall of 2008, and they said, we're going to guarantee whatever you've got in money market funds. It'll have, U.S. government backing for 1 year. So until October of 2009, all money market funds were guaranteed against loss. Pretty good. But with that came some new rules, some more restrictions, and the SEC has been working very hard to change what's permitted in a money market fund. And pretty much now, what's permitted in a money market fund is nothing. It's going to be really super short-term stuff and really super short-term and safe stuff. And let's face it, that's what should have been in a money market all along. But we're splitting even further now. What's happening is we're starting to see classes of these money market funds split. So there's going to be an institutional class of money market funds. Their value can float. Doesn't have to be $1 per share. And then there's individual money market funds. Those things won't float at all. So super long answer for a short question. I know that. But sometimes it's important to know how the watch actually works, because there is a little bit of science behind money markets. Great question that we got this week. So keep those questions coming in. You'll never know what's going to turn into a topic on a video. Thanks for tuning in, and we'll see you on episode 30. Going to be a good one. See you then.